So this video is a long time coming. Apparently, high yield ETFs are being hyped up lately on social media sites, calling them the ultimate income generator. Now, are these really safe ways to generate cash flow, or are they just another Wall Street trap? I want to take a look at it and break it down this week. Hey folks, Tom Gentile here, America's Pattern Trader, back with another video. Welcome back to the channel. If you're chasing these triple-digit high-yield ETFs lately, do me a favor, stop until you see this entire video. I want to talk about what these ETFs are, the good, the bad, the ugly, and why you might want to skip them altogether and do it yourself. Now, there are several of these out here, but for today, I want to talk about ULTY, or ULTY. ULTY stands for the Ultra Income Strategy, which is an actively managed ETF by YieldMax. They look to generate high income through covered call strategies using options. Now, what ULTY does is selects 15 to 30 U.S. listed securities based on high implied volatility, meaning their stocks could swing big. The fund sells call options on these holdings to pocket premiums, capping potential gains, but creating income. Now, for the current mix, it's heavily tilted toward tech, about 37%, with the opposite end around 8 to 9% each in industrials and utilities. Top holdings include names like Reddit, Upstart, Coinbase, basically volatile players in social media, fintech, and crypto. Overall, stocks make up 93% of the assets, with the rest in cash or equivalents from options collateral. Now, the good distributions, as they're called here, ULTY targets weekly payouts. Now, this is a big deal because people like getting paid every week. It's a big draw for income hunters. Their trailing 12-month income yield sits at an eye-popping 126%. I know, I have trouble even saying that, let alone believing it, but don't get too excited yet. First off, the latest distribution, which was announced just a couple days ago, 10 cents. And it looks like it might be even going lower. They have lowered their distributions dramatically in the last 12 months. Now, here's an even bigger catch. The payouts are a mix between option premium that they capture and a return of your capital. So for the August 8th distribution, it was about 60-40, 60% income, 40% return on capital. Most recent one has been nothing but 100% return on capital. That means they're paying you with your own money, which can erode the fund's value over time. And distributions aren't guaranteed. They can fluctuate wildly based on market volatility. So what are the risks? Wait, aren't those the risks? Nope, there's more. First, your gains are going to be capped by sold call options. So if a stock like Coinbase were to rocket, you miss out on the upside. On the flip side, you still bear the brunt of the downside risk minus the small premium that was captured. So there's no real protection below the initial premium. And let's not forget about all those fees. As a new fund, they have high portfolio turnover. That's getting in and out of all these positions. You also have non-diversification, depending on what they actually end up being in. So if 37% of that fund was tech and tech were to take a dive, it's going to hurt the portfolio. Oh, let's not forget about what the managers get. The management fee, 1.3% after expenses. And I quote, after expenses. So all of this can create a shrinking ETF price. Take a look at the ETF. Down 10.5% in just the last few months. And if you take a look at the year annually, we're talking about a 48% drop in the price of YieldMax Ultra Income Strategy. So the price is tanked. What can a fund manager do to prop up price? Well, there's two things I can think of right away. They could lower the distribution, because if they lower the payout to the investor, that means that most of it will still get stuck in the price. That keeps the NAV up higher. Online chatter is suggesting that the holders of ULTY, they're not as happy as they used to be. A lot of them are dumping out on it because of the performance. But here's another thing that hasn't been talked about yet. Reverse split. So if the fund gets too low in price, fund managers might vote on a reverse split. That's where they take away shares from the marketplace and they increase the value. So instead of, say, a 2-for-1 stock split, they might have a 1-for-2 stock split. So instead of owning 2 shares of stock, You could wake up one morning owning one share of stock at double the price. What does that do? It props up the price for new investors coming in, but it also allows the price to continue to drop further and further over time. And high turnover ETFs do this a lot. As their fees erode the ETF over time by propping it up, it sets up a crop for new buyers. If you don't believe me, take a look at this chart. This is UVXY. This is the long-term volatility index. This has undergone 9 reversed stock splits between 2012 and 2018 alone. And I'm talking about ratios between 1 to 4 to 1 for 10. That means anyone that owned 10 shares of UVXY after that 1 for 10 split owned 1 share. All right. And anyone who didn't know this would believe the long-term volatility would have skyrocketed back in 2021. Can you imagine the volatility in 2021 being above 7,000? Sounds like a Ponzi scheme, doesn't it? Now, I'm not saying that it is, but it sure feels like it, which leads me to the most important part of this video. Why not take matters into your own hands and create your own income stream instead of buying into ULTY? So you can start by creating covered calls. You pick your own stocks. You offset the cost of those stocks by selling customized option strikes and expiration dates to match your risk. Remember, one contract is good for 100 shares of stock. So for every 100 shares of stock that you buy or that you own, you would sell one contract to offset the 100 shares. By doing this yourself, what you're doing is you're potentially squeezing out even higher yields because you're not taking on constraints that the fund has. You don't have the expenses that the fund has, and you're not paying management fees like you would be to the fund. And guess what? There's other ways to do this other than simply buying stocks and selling covered calls. I have ways of doing this where we could have this for a fraction of the risk of buying stocks. So creating cash flow is one of the staples in my own account. Here's my actual returns year to date by selling premium on a curated list of stocks I follow. This is fully transparent, all of my trades. And for instance, on a 5-contract basis, this would result in about $700 in premium per month. Now, using a margin account for 5 contracts puts the account size around $4,000 per trade. I have roughly 6 open positions rolling at any one time. It just gives you an idea of what you can do. Now, a small group of traders follow me on this. I can teach you my entire system. If you're interested, check out the link in the description below. So, what do you think? ULTY's ease or do-it-yourself mastery? Hit the like button if it helped, subscribe for more breakdowns, and comment on your take. Thanks for watching. I'll see you later on the next video.